See, entering long-term liabilities is pretty easy, right? Well, I'm about to blow your mind. With accounting software, it gets even easier. Take QuickBooks, for example. As a bookkeeper, you will record long-term debt and payments the same way that you would for short-term debt. Here, let's jump over to a friend of mine and watch as they show you how to use QuickBooks to work with long-term debt.
So when setting up a long-term obligation, you're going to make sure it's on the chart of accounts in the long-term liabilities section, and it will end up on the balance sheet as a loan. Then it's time to make payments. So if you're using a system where journal entries are being done to record that transaction coming out of the bank account, your journal entry would be something like this. You're going to credit checking for the full value of the loan payment, and then you're going to have two debits in the debit column. One of the debit is going to be the principal portion of that particular payment, and that would be guided to that long-term liability, the loan you just set up on the books on the chart of account. So the other portion in the debit column is going to be the interest portion of that overall loan payment. So that would be an expense on the chart of accounts. So you go to interest expense or something like that, and it would show up on the profit and loss statement. So again, credit the bank for the full amount of the loan payment, and then you're going to have two in the debit column. Part of it's going to principal, part of it's going to interest. You might be asking, how much is principal, how much is interest? I don't know. You need to get the amortization schedule from the bank showing each particular loan payment and what the interest principal split is going to be, and then just follow that as a guide.